Welcome everyone. Today we'll be looking at indirect taxation, specifically GST accounting in Tally. Now, before we get into Tally and before we understand GST accounting in Tally, we need to understand that there is a process to filing the GST and there's a process to the maintenance of records and accounting for GST. So the GST Act, or the Goods and Services Act 2017, mandates that you have to maintain your books of accounts in certain ways for transparency, accountability, and proper tax compliance. So the first thing that we talked about is types of accounts and records to be maintained. Types of books of accounts are to be maintained. The first thing is production or manufacturing of goods, inward and outbound supply of goods, which is nothing but the purchase and sales, stock of goods movement between inter-department transfer or between different branches of a company, input tax credit availed on any purchases, and output tax paid on any sales. All of these are the minimum data that has to be maintained by any organization. These records must be maintained at the principal place of business of every organization and at every additional place of business mentioned in the GST certificate. The period of records for GST is 6 years. That means you have to maintain your books of accounts, or you have to retain your books of accounts for a minimum period of 6 years. However, in case there's any pending appeal, then you are supposed to maintain those books of accounts for 1 year post the discharge or post the disposal of such appeal, or 6 years, whichever is earlier. Example, you have a court case going on in year 3 which is settled in year 5. Then you need to maintain the books of accounts only for 6 years. But if you have a court case going on in year 5 and it is settled in year 8, then you will have to maintain the books of accounts up till year 9, which is 1 year post the disposal of that case. Now, what are the accounts to be maintained? Now, who are the people and what accounts do they need to maintain? Manufacturers need to maintain accounts of raw materials, goods in production, and the stock of finished goods. Service providers need to have proper details of what are the service provided and the invoices for the same. Works contractors or job contractors need to have proper details of any goods received, utilized, and any services availed during the execution of the service contract. Now, what kind of records do these people need to maintain? These people, or GST registered people, are allowed to maintain electric records, but they have to be available in the principal place of business. They must be authenticated with a digital signature. What are the specific documents that need to be maintained? First one being the tax invoices whenever a sale is made. We also need to maintain debit and credit notes for whenever we have purchase and sales returns. We need to maintain proper documentation of delivery challans whenever goods are being delivered, and e-way bills whenever goods are being transported. You also need to maintain details of job work orders if the case is so. Now, the GST authorities have the power to audit and inspect your books of accounts whenever they feel necessary. They may visit your premises and they may inspect your books as the case may be. What are the penalties for non-compliances? There are a lot of fines and penalties for non-compliances. They may go from a small fine up to prosecution for fraudulent activities and for lapse in record keeping. There are special records that agents need to maintain whenever they're receiving goods for principals. Whenever there's a consignment sale happening, the principal and agent needed to maintain proper detailed records of the goods and services being supplied on behalf of the principal by the agent. There are certain other provisions. For example, the composition scheme dealers are required to maintain lesser accounts as they're paying taxes under the composition scheme. And there are a lot of miscellaneous registers which companies are required to maintain. Example, a register for advances received, or a register for tax credit, or a register for TDS. Let us look at a scenario and understand what are the minimum documents that a company needs to maintain. If you can look at this company, there's a manufacturing company called ABC Limited which produces electronic gadgets. Now, first thing they need to maintain is production records. They need to have proper records of the goods being produced every day and the raw materials being consumed in that process. They also need to maintain proper records of stock registers where they record the opening balances, any goods being produced, and the closing balances. They also need to have a raw materials register of all the opening balance of raw material purchased, raw material consumed, and closing balances. The next thing that they need to maintain is inward and outward supplies records. They need to maintain records of any time goods have come in and any time goods have moved out of the go down or the production facility. They also need to maintain records for input tax credit. Whenever a purchase is made, they need to maintain proper bills and proper records to claim the input tax paid on those purchases. Output tax. They also need to maintain records of sales and properly document what was the sale made, what was the tax collected, and how much of that has to be remitted to the GST authorities. The next one is job work. In case there's any job work done, right, the job work sent, the job work received, and any wastage should be properly accounted. The next we look at is a service industry. Illustration 2 talks about XYZ company, a consulting firm in the service industry. What are the minimum records a service line industry needs to maintain? First, they need to maintain service records of all the services which were rendered by them. Second, they need to maintain invoice records of all the clients and all the invoices that were raised to the clients. Third, they need to maintain all the inward supply details. That means they need to maintain proper receipts of any goods or services being purchased by the organization on which input tax credit is being availed. They also need to maintain details of input tax credit, as you have to have documentary evidence of the taxes that you have paid which you are claiming a refund or which you are claiming an adjustment of. Finally, they need to maintain output tax documents. They need to maintain proper documentation of all the output taxes that they have collected from their customers, which they are going to deposit with the GST authorities. In the next illustration, we look at a retailer, right? What are the records a retailer needs to maintain? First, stock records. A retailer needs to maintain proper records of all the goods purchased, all the goods which are sold, and all the current total inventory. They also need to have a proper record of inward and outward supplies. That means a proper purchase register for goods purchased and a proper sales register for the goods sold. Input tax credit. They need to have a proper ledger where they show all the purchases with the GST shown separately so that they can claim input tax credit. Output tax ledger. This is a ledger of all the sales that they have made, GST shown separately, on which they have to pay the GST to the government. Finally, e-way bills. There is a mandate by the GST authorities that whenever there is a movement of goods from one place to another, if the value of the goods is more than 50,000 or there is a certain distance involved, then an e-way bill has to be generated. A retailer who is supplying goods to long distances or to far off distances, or who is selling goods of high value, has to mandatorily provide an e-way bill. The next illustration we look at is a job works contract. Whenever a contractor takes a job works contract, the minimum documentation needed is job works record, stock records, inward and outward supplies, input and output taxes. Now, what do you mean by job work records? They need to maintain a proper detailed record of what is the client, what is the job work undertaken, and what is the nature of service or product being delivered. The next thing they need to maintain is stock records of all the raw materials which were purchased, example cement, steel, sand, etc. The opening stock, the purchases, and the consumption. The opening stock, the purchases, and the consumption. The inward and outward supplies. Whenever there has been any inward or outward supplies of material, meaning whenever they have purchased any material or purchased any services of an expert, they have to document it and they have to maintain proper records with bills GST shown separately. Whenever they are invoicing their clients, proper records need to be maintained of the service for which they are invoicing the client with GST shown separately. The next document that suppliers need to maintain is the e-way bill. What is an e-way bill? An e-way bill is a documentary evidence that shows that goods are being moved from one location to another. The threshold limit is 50,000 rupees. That means whenever the goods worth 50,000 rupees or above are moving from one location to another, you have to mandatorily maintain an e-way bill. Why do we have an e-way bill? 1. The purpose is to ensure that we are compliant with the GST law. 2. It is done to make sure that the tracking of movement of goods is happening properly. 3. It provides a proper transparency and streamlines the transportation of goods. What are the components of an e-way bill, you ask me? The e-way bill has two components, Part A and Part B. Part A has the details of the transaction. Example, GST number of the supplier and the recipient, the place of dispatch from where the goods are going, and the place of receipt where the goods are going to be delivered. The document number or the invoice number and the date, the value of the goods, the HSN code of the goods, and the reason why the goods are being transported. Part B has the details of the vehicle number which is being used to transport the goods. The validity of an e-way bill is usually 1 day. Sometimes the distance will be more than 100 kilometers, in which case 1 day is not enough to travel. In that case, the validity gets extended by 1 more day. So the validity based on distance is 1 day or 100 kilometers per day. If the distance is more than 100 kilometers, we multiply the number of days. Inspection and verification. The GST authorities have every right to stop your vehicle and inspect the goods and demand for an e-way bill. The failure to produce an e-way bill could lead to fines, penalties, and in some extreme cases, the seizure of the goods. The next topic is the payment of taxes. First, we need to understand what the different types of GST. There are 3 types of GST: CGST, SGST, and IGST. CGST refers to Central Goods and Service Tax. This is that component of GST which goes to the central government. Then we have SGST or State Goods and Service Tax. This is that component of the GST which goes to the state government. And then we have IGST, which is the tax levied when goods move from one state to another. The payment of taxes can be done quarterly or monthly. We have 2 major reports that we file. One is the GSTR1 and 2 is the GSTR3. Now, in the GSTR1, we talk about our sales. We inform the government on or before the 10th of the subsequent month or on or before the 10th of the next month about our previous month's sales. That is in the GSTR1. In the GSTR3B, we have to inform the government what is my sales, what is the tax collected on sales, what is my input tax credit being claimed on my purchases, and what is my final tax liability. The GSTR3 is filed before the 20th of the subsequent month, and it has the details of the taxes which have been collected, the input tax credit which is being claimed, and the final tax payable. Now, how do you pay the taxes, you might ask? The Government of India has a very clear-cut rule that the payment of taxes happens through the electronic credit ledger. The Government of India shows all the input tax credit there, and you can use the input tax credit to pay your taxes. In case you have any additional amount of tax payable, you can do it through net banking, through preferred banking, or through credit cards. What is electronic credit ledger? The electronic credit ledger is a ledger which shows what is the amount of tax that has already been paid by us whenever we made a purchase. It shows the amount of tax paid by us to our vendors. It can be used to reduce our GST liability. The liability ledger is another ledger which shows what is the final GST liability that we have after reducing our ITC or input tax credit. What are the basic steps to calculate the tax liability? First, we need to understand our sales. Once we know our sales, we need to understand what is the amount of tax payable on sales. Next, we look at our purchases. We analyze our purchases and try to see how much of our purchases or how much of the GST on our purchases can be used for a refund claim, which is your input tax credit. And finally, we have to find out what is the GST payable on sales minus the input tax credit. The balance is the GST or the output tax liability. Once we know the output tax liability, we have to create a challan using the GST portal, and we can pay the challan using the given preferred payment modes. Finally, once the tax is paid, it will be reflecting in the cash ledger, and it can be used to set off, or it can be used to pay off the remaining tax liability, and we can use either an Aadhaar verified OTP or a digitally signed or a DSC to file and verify our returns. Now we move on to GST in Tally. Now, if you can see my screen, you can see I have a vendor named Junaid Incorporated from whom I am purchasing certain items: the iPhone 14 Pro Max, the Apple Watch Series 7, and the AirPods Pro at a certain price. I have given the HSN details, the quantity, the rate, everything for your reference. Now, how would I account for this in Tally? I'll be going with a 2-step process. First, I'll be teaching you how to create a company in Tally, and then I'll be teaching you how to account for all of this in Tally with GST enabled. Starting off, this is the screen to Tally. Now, how do I create a company? You can select the option to create a company and hit enter. As you can see, the first line gives me the address bar where the company needs to be created. I want to create the company in my personal folder, so I'm just going to go back to the address bar and change it. I've put in my personal folder where I want to save my company data. My company name. As you can see, I have created a company named Imarticus Mobiles based out of Bengaluru. My email address, my website, everything is mentioned. In India, the financial year begins from the 1st of April. Therefore, my financial year is beginning from 1st of April. But my business could be incorporated at a later date, and I have chosen the 1st of July as the date of my business incorporation. Now, with my company being almost created, you can see a screen popping up in front of you that says, do you want to maintain accounts? Yes. Do I want to maintain bill-wise entry? Yes. Do I want to maintain inventory? Yes. Do I want to maintain GST? Yes. This is where I go and submit my GST details of my company. As you can see, my GST details are that I am a registered dealer, a regular registered dealer from Karnataka with a particular GST number, and I have chosen a monthly GST filing. So, you can use Ctrl A to save your data in Tally. Now, with that data saved, let's get into voucher creation. You can directly go to vouchers and you can go to a new purchase voucher. Now, I'm purchasing a mobile from Junaid Incorporated and the bill number is JI/07/005. The date is the 1st of July and the party name would be Junaid Infotech. Now, because I'm buying goods and services from them, they will be my creditors, and I would want to maintain a bill by bill balance. Now, Junaid Incorporated is a regular dealer registered in Karnataka and I've given the GST number. With this, I have created the GST account or the party account. Please ignore the message on Tally which keeps saying that the GST number is invalid. That's because I'm using a practice GST number. Now, this screen tells me who is my supplier, what is the mailing address, and to what address am I shipping the goods. So here I can choose the shipping address and the details. Now, whenever we purchase inventory in Tally, we use a purchase ledger to account for them. So let's go ahead and do that. Here you can see the option to enable GST in Tally on the purchase ledger. I would advise you not to go and do that, as there could be a single invoice with multiple GST percentages. If you were to enable GST at the purchase ledger stage, there could be an issue where it calculates GST only at the preset rate. If I were to, for example, if I were to set the GST percentage as 12%, all the transactions would calculate GST by default at 12%, which could become a problem if I'm buying something at the 5% rate. Therefore, I would urge you not to use this to set your GST rate. I would recommend either set GST rates at individual product levels or you can use familiar stock groups. Now we come to the item creation screen. Here I'm going to create my items. I have created an item called Apple iPhone 16 Pro Max. Now, because I'm going to be dealing in a lot of mobiles, I can create a stock group called mobiles, I can create a stock group called accessories, and I can create a stock group called watches. Let's do that. Here you can specify the HSN details of mobile phones. So the HSN number for mobile phones is 85171210. I also set a constant GST rate for all mobile phones at 12%. I can create a unit, and I have created a unit called numbers so that I can keep a track of my units of inventory. As you can see, I've purchased 15 units iPhone 16 Pro Max at 1,20,000 per unit. Now I have created a subcategory called accessories. Mobile phones are inherently taxed at 12% and accessories at 18%, and the Apple Watch, being an accessory, would be taxed at 18%. Now, 10 watches have been purchased at 450,000. As you can see, this invoice has two types of GST. One is the GST on the Apple iPhone, or the GST on the mobile phone category, which is 12%, and the GST on the accessory category, which is 18%. So I will be creating another ledger called, since this is my purchase, this is my input tax ledger. Here I have created a ledger for my input tax credit. I have two types of input tax credits. One is my GST on 9% on the accessories, and second is the GST on the mobile phone purchased at 6% CGST and 6% SGST. As you can see, this invoice is now worth 25,47,000, which is way above the 50,000 limit. If I press enter, this is going to ask me for e-way bill details. Right now I do not have them, so I choose to say no. And this is a new reference with a new bill. And that is my purchase recorded in Tally. Similarly, we have a few more transactions which you can record. How about pausing the video here and trying to record this transaction by yourself? As you can now see, I am now creating the ledger of Bhavik and Company. I've already created the ledger of Bhavik, and I am also accounting for the purchases. Now, I am purchasing new products, so I will have to create ledgers for that. I have the product name Samsung S24, which falls under the category of mobile phones. I already have a category called mobiles. I can just use that stock group. I select it, and my GST data auto-populates. The next item I'm creating is the Samsung Buds Pro. As you can see, I already have a group called accessories, and I'm just going to select that, and the GST data again auto-populates. Now, because this is a local purchase, again, I can just use the same GST accounts I made in the previous entry. The next vendor I have is Ansari LLP. I advise, why don't you pause your screen and try to account this in your screens. As you can see, I have created a company called Ansari LLP, but I have created the company at Tamil Nadu. My company, Imarticus Mobiles, is registered in Bangalore. So when I am supplying goods or when I am purchasing goods, at both situations, IGST would be applicable. Hence, if I try to use the old GST ledgers, they don't work. So what do? Let's create a new ledger. This is a case of IGST or integrated GST. So I have to create a ledger as integrated GST directly at 18%, not at 9 and 9. And as you can see, it auto calculates. Similarly, for the mobile phones, I have created a ledger called IGST at the rate of 12%. It is a duty or a tax, and it comes under GST, IGST at 12%. As you can see, this is auto calculated as well. That brings us to the end of our purchases series. As you can see, I have now created the accounts of customers to whom I am selling these products. I have created a customer account called XYZ company. As you can see, I have now created a company called XYZ company, which is a customer account. I am selling 3 products to them: the iPhone 16 Pro, the Samsung S24 watch, and the Apple Watch series. I do not need to create any separate stock items because I already had them. I just had to create 2 accounts: the output CGST at the rate of 6% and the output SGST and CGST at the rate of 9%. That's it. Now we'll understand how do we record an interstate sale, right? I am going to create a company called Nikhil Enterprises. Now, because they're buying goods from me, they are going to be my debtors, right? And Nikhil Enterprises is based at number 1 MG Road, Mumbai, and the state would be Maharashtra. My company is registered in Karnataka, whereas Nikhil Enterprises, as you can see on your screen, is registered in Maharashtra. So obviously there's going to be an IGST transaction. I am making a sale, so I just use the sales account, and I already have the products created. For example, I have the item called the Realme GT Pro, 10 units at 150,000, and the Realme Buds, 5 units at 7,500. Now, the output GST accounts clearly don't auto calculate the GST. Why? Because this is an interstate transfer. I have to create a new account called the output IGST account because this is an interstate sale. And because this is an interstate sale, the account is created at the full value, which is 18%. Duties and taxes, GST, IGST, 18%. Similarly, output IGST, 12%. GST, IGST, 12%. And this is how we do our GST accounting for purchase and sales.
Found this session valuable? Hit the like button, subscribe to our channel, and tell us in the comments below what topic we should dive into next.